Hello and welcome to the channel. I appreciate you stopping by. This video is all about the price action of the market for the Friday and the week ending October 10th, 2025. I'm going to go over a market summary and check out the S&P 500 price chart and find some key support areas along with what I expect to happen this next week. Let's get started. I intentionally have this S&P 500 chart excluding the Friday close because in preparation for a live stream on Thursday, October the 9th, I was looking at potential support levels from a risk management perspective and how I manage my portfolio. And on that Thursday, as I was preparing and didn't actually share it on the live stream, I'm a little disappointed in that now given what happened on Friday. But we closed on the 9th about 0.98% above the 20-day moving average, so that was one support level. The 50-day moving average was sitting around 3.11% below the price on the Thursday close. Then I was looking at the February high, which was on February the 19th. We closed at 6144.19 on the S&P 500. So that was another support level. And then down here is the 200-day moving average, and we closed above that at 10.23%. And then finally, one other support level would have been the April low, which would have represented a 27.09% drawdown. So with that in place, I am going to change this to also include Friday's close, because most of us know what happened. That we had some escalations in the trade disputes between U.S. and China, and when some tweets went out and other exchanges between the two countries went out, we saw a big sell-off in the market, and the S&P dropped 2.71%. So we'll come back to this chart here in just a few minutes. I want to go to the dashboard and look at all of the indices along with the sectors. So the Dow did close down 1.90% on Friday. The S&P 500 closed down 2.71%, and the NASDAQ closed down 3.56%. And we also saw a pretty big jump in the VIX, or the fear index, and it was up 31.83%, settling in at 21.66, which is above the line in the sand that I typically use of 20, where we're starting to see fear enter back into the market. When we look at the cap-weighted S&P 500, consumer staples was the only sector that was in the green, and it closed up 0.08%. This is generally considered a very defensive group, so it's really no surprise that that was actually up as people rotate from higher risk assets to lower risk assets. That was followed by utilities and real estate. Both are also considered defensive, although real estate did close down minus 1.09%. And then technology was at the bottom of the sector list, closing down 4.07% on Friday. Energy just above that, closed down 2.89% on Friday, basically on growth scares when you get these escalating tensions. So when we see a pullback in the S&P 500 of this magnitude, I generally like to go back and look at other dates where that may have happened. On March the 10th, we did have a 2.7% pullback, so that's nearly identical to what we saw today. Then on April the 3rd, in the midst of the tariff announcements back in April, we saw a pullback of 4.84%. And then in the very next day, we saw a pullback of 5.97%. So I'm kind of expecting that we're going to see some subsequent sell-offs here in the next few days. Monday, it would not surprise me if we had somewhat of a recovery. But unless this trade tension is de-escalated here quickly, I do expect that we're going to see a few more down days challenging the 50-day moving average or even the February high, which was 61.44.19. So those are some price targets that I'm keeping in mind as we go through the week. Since we came out of the tariff announcements and started on this slow grind higher to where we were just a few days ago, we can see that we had tested this 20-day moving average about 3 or 4 times since April. We had never tested the 50-day moving average since coming out of that announcement. And looks like we did test the 200-day once back in late May. That's the only test of the 200 that we've had. Since that point, we have had a golden cross where the 50-day does cross above the 200-day. So we have the 20-day, the 50-day, and the 200-day all upward sloping and in the proper order. So why I was cautious as we moved, have been moving through the markets over the last couple of months. One of the things that we'll notice is we had what we call a negative divergence where the momentum was decreasing, but the price was increasing. That's usually a cautionary note. It doesn't always mean that you're going to have a pullback, but it is something to be watching. One other thing that kind of concerned me and what made me start looking at the risk management is the put-call ratio. I have the raw data in the background in this gray line, and then I have a 5-day moving average to that put-call ratio as well. And normally when the put-call ratio is as low as it is today, that means people are not buying any kind of insurance or protection on their portfolios. And typically when you get to a low value such as that, let me turn on my cursor. So here's a low value on the 5-day moving average. And if you look at the price chart, we actually had a decrease or a small pullback. We can also see other times when it is either whenever it gets really high, market makers start coming in and adjusting the price upward, which they did in this particular case. Here's another low reading, and we saw a little bit of a sell-off. So watching this just tells me that people were not being very cautious. They were more bullish, and market makers typically step in, especially when there's an event like there was on Friday. So this is still a pretty low value, and with an ongoing event, I actually expect the put-call ratio to actually increase. We could get back to a level of between 75 and 82 I don't know if we'll get back to these really high peaks, but we could. So I think we have a few more days using the 5-day moving average where we can expect people will start moving in and buying some protection for their portfolios. But until that's fully in place, we can probably expect some additional downward movement. Although we could have some tactical bounces. These secondary indicators aren't perfect, but we could have some bounces. But overall, I'm expecting that we're going to have a little bit of a pullback, maybe down to this February high. I want to go to an intraday chart. I want to look at this intraday chart and see what we notice. Now this is on the SPX. I'm actually going to change that to the SPY, which is a proxy for the SPX, and I'll tell you why I'm doing that here in just a moment. But we can see we had increased at the open on Friday, and once that announcement was made, it was continuous selling for the rest of the day. And even into the extended hours, which I'll turn on here, we can see that we still had sell-off in the after hours. And we did see a little bit of an increase later on in the evening after the markets had closed. It'll be very interesting to watch this tonight when the aftermarket opens back up for trading and see what happens in the aftermarket, and then certainly when the market opens tomorrow morning. Now the bond market is closed on October the 13th for a holiday, so the bond market won't be reacting on Monday. Since I'm a retired investor, my portfolio tends to be fairly conservative, defensive. I invest a lot in income, but I do have some growth components in my portfolio. So one of the things that I'll point out is in March and April, when we had the S&P drawdown and got down to -4.5 and -5.3, that my three portfolios never went below zero. They did on a weekly view, but on a monthly view they did not. And they have been outperforming the S&P 500 since that time. Now we have had a drawdown in September. One of my portfolios did see a bit of a drawdown in September, but the other two performed well in September, but we're seeing pullbacks across the board in all of my portfolios, and my combined portfolio, which is in the blue here, is combining all three portfolios together. So I am mostly defensive, so I think my portfolio will handle a pullback that we might expect. But I can tell you that I had been doing a little bit of trimming for the past month, and on Friday I did close out any of my bullish leveraged ETFs, which I only had one open on the called the TNA, which is a 3x bull on small caps, and I had been up about 20% on that one since August the 13th. But with the pullback on Friday, it had pulled back pretty significantly, so I went ahead and closed that out for a profit. I don't want to hold a bullish hedge when the market could be decreasing. And then on Monday, I'll be looking at adding some leverage to the downside on the triple Q, either through the S triple Q or the PSQ. I'll be looking at adding those to my portfolio. just for a short time, maybe a week, maybe up to a month if needed, as long as they perform well, just to provide a little bit of a hedge to the portfolio. So that's my plan moving forward. Other than what I've already done, I don't plan to make any major changes to my portfolio. So I hope you found my thoughts helpful as we navigate these tariff uncertainties and escalations here over the next week or two until they get resolved. We also have the government shutdown in place. So anyway, I hope you've enjoyed this. I hope it helps you, gives you some ideas on where you might want to be adding back to your portfolio if we reach certain risk targets. So keep that in mind, and let me know in the comments below if you have any specific plans on how you intend to navigate this uncertainty this week. So let me know in the comments below, and if you're not subscribed to the channel, please do so and like this video so others can find it as well. I appreciate you stopping by, and I hope it's helpful. Take care and trade well. Thank you.